Investment strategies, a comprehensive overview. Investing in the financial markets offers numerous opportunities for individuals to grow their wealth over time. However, the approach one takes can significantly impact their success. Here, we delve into 4 prominent investment strategies: long-term investing, value investing, growth investing, and dividend investing. Each strategy has its unique principles and objectives, catering to different investor goals and risk tolerances. 1. Long-term investing. Harnessing the power of time and compounding returns. Long-term investing is a strategy that emphasizes patience, discipline, and a forward-looking perspective. It involves purchasing investments with the intent to hold them for a significant period, often several years to decades, rather than seeking quick profits from short-term market fluctuations. This approach is rooted in the belief that markets tend to increase in value over time despite periodic volatility. Key principles of long-term investing. 1. Compounding returns. Compounding is the process where the returns on an investment generate additional earnings, which are then reinvested to generate further returns. Over time, this creates a snowball effect, significantly enhancing the growth of an investment. For example, if you invest $1,000 at an annual return of 7%, it will grow to approximately $1,967 after 10 years, thanks to compounding. 2. Market growth. Historical data shows that financial markets generally trend upwards over the long term, despite short-term dips and crashes. This trend is driven by economic growth, technological advancements, and increasing productivity. By staying invested, long-term investors can benefit from the overall growth of the economy. 3. Patience and discipline. Long-term investing requires a steadfast approach, resisting the urge to react to short-term market noise. Successful long-term investors stay focused on their financial goals and stick to their investment plan, even during periods of market volatility. Benefits of long-term investing. Reduce transaction costs. By trading less frequently, long-term investors minimize the costs associated with buying and selling securities, such as brokerage fees and taxes. This can have a significant impact on overall returns, as frequent trading can erode profits. Tax advantages. Investments held for more than a year are typically subject to lower long-term capital gains tax rates compared to short-term capital gains, which are taxed at ordinary income rates. This tax benefit can enhance after-tax returns, lower stress, and improve decision-making. Long-term investing can be less stressful compared to short-term trading, as it involves fewer decisions and less frequent monitoring of the markets. This can lead to better investment decisions, as investors are less likely to make impulsive moves based on short-term market movements. Strategies for long-term investing. 1. Diversification. Diversifying your portfolio across different asset classes, such as stocks, bonds, and real estate, can reduce risk and improve potential returns. Diversification helps mitigate the impact of any single investment's poor performance on the overall portfolio. 2. Regular contributions. Consistently adding to your investments over time, regardless of market conditions, can enhance growth through dollar-cost averaging. This strategy involves investing a fixed amount regularly, which can lower the average cost per share over time and reduce the impact of market volatility. 3. Focus on quality. Investing in high-quality companies with strong fundamentals, such as consistent earnings growth, robust financial health, and competitive advantages, can improve the likelihood of long-term success. These companies are more likely to withstand economic downturns and continue growing over time. Case studies and examples. Warren Buffett. Warren Buffett, one of the most successful long-term investors, has amassed significant wealth by investing in high-quality companies and holding them for decades. His investment in Coca-Cola, which he started in 1988, has grown substantially, demonstrating the power of long-term investing. The S&P 500 Index. The S&P 500, a benchmark for the U.S. stock market, has historically provided an average annual return of about 10% over the long term. Investors who have held an S&P 500 index fund for several decades have seen substantial growth in their investments. Long-term investing is a powerful strategy that leverages the benefits of compounding returns, market growth, and disciplined investing. By focusing on high-quality investments, diversifying, and making regular contributions, investors can build substantial wealth over time. This approach not only enhances financial security but also reduces the stress and transaction costs associated with frequent trading. Understanding and implementing the principles of long-term investing can lead to sustained financial success and the achievement of long-term financial goals. 2. Value investing. Discovering undervalued opportunities. Value investing is a strategy focused on identifying and purchasing securities that are undervalued by the market. This approach is based on the idea that stock prices do not always accurately reflect the true intrinsic value of a company due to various market inefficiencies. By buying undervalued stocks, value investors aim to profit when the market eventually recognizes and corrects the mispricing. Key principles of value investing. 1. Intrinsic value. Intrinsic value is the true, inherent worth of a company based on its fundamentals, such as earnings, dividends, and growth prospects. Value investors seek to estimate this intrinsic value through thorough financial analysis and compare it to the current market price. If the market price is significantly lower than the intrinsic value, the stock is considered undervalued. 2. Margin of safety. The margin of safety is a crucial concept in value investing. It refers to the difference between a stock's intrinsic value and its market price. By purchasing stocks with a significant margin of safety, value investors reduce the risk of loss and increase the potential for gain. This principle helps protect against errors in judgment or unforeseen market fluctuations. 3. Fundamental analysis. Value investors rely heavily on fundamental analysis to assess a company's financial health and prospects. This involves examining financial statements, such as the balance sheet, income statement, and cash flow statement, as well as evaluating qualitative factors like management quality, competitive advantages, and industry conditions. Strategies in value investing. 1. Identifying undervalued stocks. Value investors look for stocks that are trading at a discount to their intrinsic value. Common metrics used to identify undervalued stocks include the price-to-earnings (P/E) ratio, price-to-book (P/B) ratio, and dividend yield. Stocks with low P/E and P/B ratios or high dividend yields relative to their peers may indicate potential undervaluation. 2. Contrarian investing. Contrarian investors deliberately go against prevailing market trends. They seek opportunities in stocks that are currently out of favor with the market, believing that these stocks are undervalued due to temporary issues or negative sentiment. By investing in such stocks, contrarians aim to benefit when market sentiment improves and the stock's prices rise. 3. Deep value investing. Deep value investing involves finding stocks that are extremely undervalued, often in distressed or overlooked companies. These stocks may be trading at very low valuations due to significant but temporary challenges. Deep value investors take on higher risk with the expectation of substantial returns when the companies recover or when the market recognizes their true value. Benefits of value investing. 1. Potential for high returns. By purchasing undervalued stocks, value investors position themselves to benefit from significant price appreciation when the market corrects the mispricing. This approach can lead to substantial returns, particularly if the investor accurately assesses the company's intrinsic value and the stock's potential for recovery. 2. Risk mitigation. The margin of safety concept helps value investors mitigate risk. By buying stocks at prices well below their intrinsic value, investors create a cushion against potential losses. This reduces the impact of adverse market movements or errors in valuation. 3. Focus on long-term fundamentals. Value investing emphasizes a long-term perspective, focusing on a company's fundamentals rather than short-term market fluctuations. This approach aligns with the belief that strong companies will ultimately be recognized by the market, leading to price appreciation over time. Famous value investors. 1. Benjamin Graham. Often referred to as the father of value investing, Benjamin Graham laid the foundation for this investment approach. His seminal works, Security Analysis and The Intelligent Investor, introduced key concepts like intrinsic value and margin of safety, which remain central to value investing today. 2. Warren Buffett. A disciple of Benjamin Graham, Warren Buffett is one of the most successful and well-known value investors. As the chairman and CEO of Berkshire Hathaway, Buffett has built a multi-billion-dollar empire by applying value investing principles. His investment philosophy focuses on buying high-quality companies at reasonable prices and holding them for the long term. Value investing is a disciplined and strategic approach that seeks to capitalize on market inefficiencies by identifying and purchasing undervalued stocks. By focusing on intrinsic value, maintaining a margin of safety, and conducting thorough fundamental analysis, value investors aim to achieve substantial returns while mitigating risk. This strategy requires patience, diligence, and a long-term perspective, but it has been proven to yield significant rewards for those who master it. Whether through identifying undervalued opportunities, adopting a contrarian stance, or engaging in deep value investing, value investors can navigate the complexities of the market and uncover hidden gems that offer potential for significant appreciation. We need your support to help our channel grow and reach more people with our engaging content. By subscribing to our channel, you'll stay updated on all our latest videos and help us reach new audiences. So, if you enjoy our content and want to be part of our community, hit that subscribe button and the bell to join us on our journey. Thank you for your support. Together, we can make our channel thrive and create even more amazing content for you to enjoy.